Welcome to Real Cash Flow, the only show that takes you full circle with your money, covering stocks, bonds, commodities, currencies, crypto, insurance, and real estate. I'm your host, Andrew Michael Arroyo. Let's get started. Welcome back to the show. Today, we're doing a follow-up on the precious metals complex. In our inaugural episode, we went over the breakout in both gold and silver. And today, we're looking at the entire metals complex nearly 60 days later. What has happened? Has that breakout held true? And what are the best plays today based on the charts? So I'm joined in the studio by Jason Riehl. Welcome to the show, Jason.
Good morning, Andrew. Happy to be here.
Excellent. Excellent. So for both of us who have studied these metal markets for nearly 20 years, watching a breakout like we saw in April was something we've been waiting for, and both of us were long. And so now the question is, as we've enjoyed the profits, I was transparent in the first episode about my personal positions. I had options at the 20 call mark, 25 call mark, and SLV. Those are both in the money. Those have both done very, very well. I was long SLV and had a variety of smaller positions. And I know you do swing trading and smaller trading. Now that we've seen a little bit of a pullback, some consolidation, the overall trend is still up, clearly. What do you see as the best place for someone to enter that missed out on that first rally that we saw in April?
Well, a lot of the complex moves together, as we know. If gold moves and silver will move, or vice versa. But it does, in my opinion, silver is a good place to be. There's silver miners. I'm still holding the stuff that we on the breakout. I still have some longer swing term positions. I had sold out of the shorter stuff, but now, based on um, the silver and the silver miners, seems like they're finding support back at that area that used to be resistance that gave us the big breakout that woke everybody up. We're back to that area now, and it does seem like buyers are stepping in again. So silver itself as a commodity, or the silver miners, I think is a good place to start nibbling again, because you can start small and then wait for some confirmation and then add. So even if it's the silver and the metal itself, or the silver miners, you can see it's down about 10% from its highs. So a lot of people even look at that for something that's in a strong trading market, whether it's commodity or something else. A 10% pullback's pretty decent over a month's time. So silver is catching my attention again right now.
Excellent. And we like to look at the underlying commodity itself in the futures market. So if you're looking for which charts to study, or which fundamentals to go do your research on, what I would recommend is the continuous contract, the end of day spot price continuous contract. And you can find these on websites like barchart.com. You can go to the Chicago Board of Trade or the Mercantile Exchange. There's some charts there as well. And then we're big proponents of stockcharts.com. We're both part of that community. But if you take a look and you look at that silver chart, we're going to focus on this today because, as Jason said, you've got a clean 10% pullback. And in a big breakout bull market rally, that is a healthy place to take a look for entry, as long as you understand and can protect your downside risk. So if we look at the silver chart on a weekly basis, it topped out at 32 and 75 cents. And today we're at 29.56. So you've got that 10% pullback. Now, as far as the moving averages, we've got our 5-day, our 10-day, and our 20-day. It is acting appropriately. It is above the 20-day. It bounced right off the 10-day, slightly below the 5-day. But ultimately, everything is going the way you want to see it go into a breakout. One thing I'll mention about silver, just because I've traded it for many years and studied the historical data that goes back, nearly 100 years at this point, is that I just want to share with the listeners, it tends to have a very, very sharp breakout, and it tends to pull back very, very quickly. So It's not necessarily something that I'm recommending you're going to be buying and holding, like gold, for example. It's something that when it does have its sharp, out of whack drive to the upside, you do want to take some off the table. And that's what I did during the bull market rally we saw in April and May. When I saw extremely heavy volume, I'm looking now at a monthly chart. You can do the same if you're looking at those continuous contracts. We saw between 200 and 250 million contracts traded. Now, if you look back at the last 10 years, there is only a handful of months, less than five, where you saw contracts trading over 200 million. And so when I saw that, we had that big run up. I didn't ring the bell exactly at the top, but it was over 30, maybe 31 and change. That let me know it's time to take a little bit off the table. And so now I have the choice. I could re-enter the position. I've got 10% discount, if you will, or I can continue to hold my position, which I am doing thus far. So when you look at the monthly chart, Jason, we'll get to the gold and silver ratio chart. That's something I'm a big proponent of teaching people to compare the two. As you mentioned, they do move in tandem. However, at some points in time, they get out of whack, meaning silver will be trading much, much higher compared to gold and vice versa. And those can be good buy or sell signals before they come back in equilibrium. But when you look at the monthly chart of silver, what do you see here?
Well, that the breakout that caught all of our attention, that when we poked to that high at what was that in April of that 32.75, what you can see is a higher high. So if you look back to 2020 and 2021, the highs from that area were 29.52 and 38.35. So this is a technical reversal, we call it. So if you bear with me, if you go back to the low in 2020 at 1164, then you look in 2022, you have a higher low at 1740. So that means that buyers stepped in at a higher price. So the buyers are in control between the time of 2020 and 2023. And then as you go through 2023 and 24, you can just see continuous higher lows. And then the trigger or the technical reversal happens when you get a higher high. So that's the 32.75 that we see in this year, poked over those highs in late 20 and early 2021. So if we went back farther in this chart, silver was up to $50 or so, and it's been basing for a while. And then you can see now, and now that you brought up that longer term chart, you can see we have a technical reversal here, which is we have a higher high and a higher low. And that's a great starting point. And that's something that should get your attention on charts and chartists and technical technicians. When they see that, it's something to pay attention to because odds are favoring that there's going to be higher prices to come. How long and how high, we don't know. But that type of pattern is something to look for, whether it's on this chart or any chart that you're looking at prices, no matter what the vehicle is.
Mark Twain once said, history doesn't repeat itself, but it usually rhymes.
Yeah.
And I think when we look at the historical chart of something like silver or some of the other commodities that are quite cyclical, I'm looking at a 20-year chart at this point of silver. You can see so many parallels to what we saw in the early 2000s with the run up in silver. It hit a peak of 21.44 in 2008. It dumped with the rest of the market in 2008 all the way down to $8.40. And then it rallied like a complete bull between 2009 to 2011 all the way to 49.82. So if you were wise enough and you had the steel stomach to be buying when everyone was selling in 2008, and even if your average price was at 10, that was a 5x within a 2-year period. And if you really had a steel stomach and you were willing to leverage in the futures market, you could have done quite well. So we're going to use that period of time as a model example of what's possible. As I just mentioned, history doesn't necessarily repeat itself from a charting standpoint, but there's many parallels. It often rhymes and gives indicators of what's possible. So if we look back at that period, now let's rewind time. In 2009 and 10, 11, you had the dollar at a much, much lower range than it is right now. As I recall, it was trading between somewhere around 90, maybe 95. Today it's up at 105. So that's a tremendous difference. And you didn't have interest rates being hiked. I mean, they were hiked in '04, '05, '06 to kind of curb that real estate boom. But ultimately, we were down for the count as an economy. We had already lowered the interest rates near zero as far as the Fed funds rate. And we were really struggling as an economy to get the economy fired back up. And so, because you had stocks and bonds and other asset classes that weren't really performing, it made a lot of sense for precious metals to be the star of the show and people to invest. And you see big runs across the commodity board, but specifically in precious metals. So today, let's fast forward. Here we are, 2024. You've seen this breakout. And if you look at the charts between mid 2010 and mid 2011, and I'm looking at silver specifically, but you could also trace gold, you're going to see a breakout around the 20 range. And I'm going to count the months because this is important. This is something my mentors taught me when it comes to charting. I'm going to count the months: one, two, three, four, five, six, seven, eight, nine. So there was a 9 month run that was straight vertical. Every single month except for one, do you see a new higher high? There's a lot of volatility in there, but you did see a higher high. And if we're going to emulate what we saw in 2010 and 11, which would be very desirable for anybody that's in these metals positions, and we fast forward to today, well, the breakout's not 20, the breakout is 30. And so we've broken out of 30. This is month three. Arguably, it could be even month two, but let's just call it month three with that high volume. And so potentially we could have another 6 months ahead of us. So, my recommendation for listeners is yes, pay attention to the daily. Yes, pay attention to the weekly. And if you're trading these positions, of course, have your downside risk, your buy stops, your sell stops all in place to make sure that you're not trading more than you can afford to lose. But if you're a long term trader like myself and you're really looking at these long term trends, well, the next 6 months will be very indicative if we're going to get another period of history with high volumes in silver like we saw in 2010 and 11. So, what's crucial in the month of June and July is that we do take out this high of 32.75. Even if we see a sharp rally up and then a sharp rally down, that monthly stick and these weekly sticks are critical for the algorithms in the program traders that are out there that are trading simply on the charts. So, Jason, as you reflect back, we used to be looking at charts and sharing all this information in 2009, 10, 11, witnessing some of those big rallies and then the aftermath of what happens next, because I think that's equally important. Sometimes people get married to these positions. And if you had held on in 2011 thinking, oh, wow, it went to 50, it's going to go to 100. Well, you would have had a sad ending because 2 years later, you would have been right back to that $20 breakout and then sat around for nearly 10 years waiting for it to break out again. So when you look at the historical, what are the learning lessons for you?
Yeah, it's a reminder. As you talk about a lot too, we're looking at different asset classes. This is one specific asset class, commodities, and they move different than the equities do, or your S&P 500. It's different if you were buying the S&P in 2011 and you held on to it because it's up multiples from then. But you have to keep in mind this is a commodity. There's shorter term moves. It's a 9 month move and then it's over. So don't look a gift horse in the mouth. If we do have a couple good months, it's just about not being greedy. It's one saying that goes around in the trading circles, I guess you could say, is there's always another trade. So at this point in time, we're focused. You and I are focused on the silver and the commodities for technical reasons and also for fundamental reasons. There's a lot of reasons to be looking at it, but it's not going to last forever. So have a goal in mind, have your stops in place, and most important thing is your money management or your position size, or when you're looking to get into any type of, whether it's a silver play or another one, it's how much you're willing to lose. Because once you have that in mind, then your comfort level goes up, and then you're okay on the trade. So just have a target, and if you get out, you can get back in. But the main thing is, I think, is that there's differences between investment vehicles. I mean, we're focusing on the stuff now that's active and that is offering opportunity. But this also comes with other, let's say, rules, just because of the way the commodities move. So opportunity is there. Don't be afraid to take a profit. You can't go broke taking a profit. So just take money off the table, especially in the commodities and these quick moving plays.
It's great, great advice. And the opportunity cost, let's talk about that because I've painted some pictures about my position and recently it's done well with the options, it's done well with the long-term hold, it's done well with the physical holdings. However, there's a flip side to this coin, and that is that I started accumulating heavily the physical assets and then ultimately the ETF as early as 2016 and 2017. So I was early at the end of the day. Now, the good news is there, besides COVID, there wasn't really any downside periods. There was for a few months, and there's nothing more alarming when things drop 30, 40% in a short period of time, but the whole market did that. But I held through that. But my point is, my opportunity cost between 2016 and 2000, say 20 or 21, it did cost me money. So although I didn't lose on the position, the S&P and many of the equities did much, much better than the precious metals complex. So in that way, it was a loss. So this is why it is so critical to be diversified. It's very important for you to understand that commodities in general are cyclical. They are based on supply and demand. They're industrial materials at the end of the day. So although precious metals specifically has this little carve out that people think of as security and a flight to quality, an alternative to currency, at the end of the day, it is an industrial metal. It's a commodity. And that's what is the main driver of supply and demand. So, what we're seeing now, as far as fundamentally speaking, is that central banks in April made a decision to start moving out of the dollar. And you saw that within the bond market and the US Treasuries and start buying gold. And so that's the primary driver that I see fundamentally. I don't see the speculative drivers that I've seen in the past because Bitcoin has stole the show, which we're going to talk about here in just a moment. So, and I'm going to read you as we're on that topic, I'm going to read you just some fun facts about cryptocurrency, especially for the skeptics, because I certainly was one of them for many years. I have now changed my tune as I have seen Bitcoin come in to the global markets. They've now had the ETF approvals, and I'm going to read some alarming statistics. Number one, do you know how many Bitcoin owners there are in the world? 106 million. Over 200 million wallets at this point in time. There's 53 million Bitcoin traders. And you can look these stats up if you'd like on your own. Go to buybitcoinworldwide.com. If you go to security.org, this is another website that I found some fascinating statistics, that 40% of American adults now own crypto. And that's up from 30% in 2023. But here's the most alarming statistic that I came across, and that is that as of March 2023, the top 1% of Bitcoin addresses, that's the wallet addresses, hold over 90% of the Bitcoin supply. And that's bitinfocharts.com. So, assuming those statistics are accurate, and that's a big assumption because there's a lot of hype around Bitcoin, but you Google, you'll find similar statistics. Assuming that's the case, well, the general population has bought in. The majority has bought in to crypto in general. And for those of you who are still believing crypto's the next tulip frenzy, well, it's going to take a couple 100 million people worldwide to give up on something that they've put their trust in. And then secondly, the fact that last stat that I read, that's the most concerning. The fact that 1% of the Bitcoin holders own 90% of all the Bitcoin out there. That is very concerning because when you think of it from a market maker perspective, you have to be wondering if those 90% decide to sell in unison, what happens to the asset class at large? So, Jason, I know we're pouring into the metals complex and we're going to continue. We're going to give some suggestions for ETFs that people can buy. But before we do that, I do want to talk about Bitcoin because it is now the alternative for precious metals, and it really has stolen the show, is what I like to say. It used to be the gold and silver where flight to quality was. Now it's Bitcoin. So, for one, do you believe, as much as these 150 million Americans or 150 people worldwide believe, that Bitcoin is the future? And how do you see it impacting the flight to quality this round for gold and silver?
Yeah, it is interesting. I hold Bitcoin myself. I actually do some dollar cost averaging on a weekly basis, a small amount, turning my dollars into Bitcoin. And if it's supposedly based on an algorithm. I've heard there are some conspiracy theories out there, but in general, it's mathematics that are driving it. So it's a limited, 21 million Bitcoin are supposed to be all that will be created or mined. Um, and it's obviously having an effect on, on the flight to quality, or like you say, versus gold and silver, because it's just the ETFs that were released in the last 6 months have garnered, I don't know what it is, half the dollar volume or more than what gold has, and the gold ETFs have been around for decades, or a couple decades at least. So Bitcoin is real as far as I'm concerned. Outside of its ability to trade, its volatility, it moves fast. That's why it attracts traders, but also for diversification out of the dollar, no counterparty risk that you have with currencies. And then at the same time, it offers a lot of, it has a lot of potential social positives as far as second, third world countries that don't have the ability to bank, or the governments that are there, are very strict, or they don't, they're, excuse my French, screwing over the population. Bitcoin is an option since it's not controlled by any central government, that it can have some positive social benefits for allowing commerce and people being able to create wealth outside of the heavy hand of a specific government or something like that. So there's a lot of positive to it. It's usually things that, we're only 10 years into Bitcoin. It's only been around for not too long at all. Very early innings. So it's the another one way I like to look at it too is we've seen let's say um, a lot of transitions from analog to digital. So this is basically the financial how I want to say it, the financial transformation from analog money, or quote unquote transfer of money, to the digital version of it. And that's happened with almost every sector and everything, between your voice, analog over copper wires. Now it's running on light, and then do the computer itself and the internet and stuff like that. So if you think about it that way, it's kind of logical, and it is happening. It's right in front of you. Like they say, trade what you see, not what you hear or what you want. So it's here, and I think it's here to stay. And I think it's good to have an appropriate amount of cryptos in your portfolio based on your risk. So I don't see it going anywhere.
And digital currencies are certainly here to stay. The next stage will most likely be governments introducing their own digital currency and paper currency fading away. When that happens, the question is, if that is traded on blockchain, will that again take the show, or can cryptocurrency, this decentralized currency worldwide, continue on with the same bullish patterns? So what we've seen is a couple things these last 6 months in Bitcoin. As you recall, if you've been a Bitcoin investor or trader, it had its heyday where it rallied from a few thousand all the way up to 70,000, which was incredible in 2021. Then it got taken apart when the NASDAQ got taken apart. It dropped all the way down to 16,000. My gosh, it was almost like a 75% decline. And the fact that it's rallied right back up, and I do believe gold and silver gave it some tailwinds. Now it's right back up to that 60, 70,000 mark. It's floating around within that range. There was a split. I know every few years it does split. To Jason's point, there's 21 million out there and it's controlled. They're not diluting it by producing more and more. And every time it splits, it typically has a huge rally. We did not see that this round when it recently split. But what we did see is there is now more than 10 Bitcoin ETFs that have entered the market. If you have been following Bitcoin as far as the stock market's concerned, you would remember or know that Grayscale Bitcoin Trust was really the largest um, security out there. It was a trust, it was not an ETF, and it came with some pretty substantial management fees. It was 1.5%. And now, ever since the approval for ETFs in January 2024, you have seen a flood of Bitcoin ETFs from all the major players. You're seeing iShares enter the space, Fidelity enter the space, Invesco enter the space, Wisdom Tree enter the space, and on and on. And these management fees are like a quarter of 1%. 25 basis points. So, what this does is it now provides an institutional grade ETF for the larger players to be able to invest into Bitcoin. And for that reason alone, I do believe they have just extended the life of Bitcoin, even if those 90% of the majority that hold Bitcoin were to sell significantly, you're going to have a lot of institutions over the next few years, which will now be holders as well. So I do believe it's a shift, a more of a diversification of new shareholders for Bitcoin that's coming this round. And hopefully we'll see some stability as far as the volatility moving forward. So let's transition back. We are going to do a separate show specifically on cryptocurrency, but to stay focused on the trades of the day and giving you an opportunity to look at some ETFs that have to do with commodities, whether they're gold, silver, whether they're precious metals, miners, copper. There's a variety of ways that you can trade, and we'll start with those tickers now. You have GLD for gold, so that's GLD. You have SLV for silver, and that's specifically to silver. You also have, again, those Bitcoin trusts that you can look at, and you can Google. There's a variety of those ETFs. You can pick your favorite flavor. And then for copper, you have COPX, and that's the global copper miners. And then if you want to trade the silver complex in general, you can choose SILV. And if you're looking specifically for one stock we're going to talk about now in the copper complex, that is SCCO. And we will put those in the show notes. But Jason, we've talked about silver. I want to transition to copper real quick because copper has had an interesting pullback. Maybe it's even more actually than silver. It's more like 15%. The commodity itself was trading over 5. That's a record high for copper. It has hit very close to 5, but it did go to 5.2 in the futures market, and that has pulled back to 4.5. So that's a substantial pullback there. And let's focus on SCCO. That's a ticker that you brought up, and it's performing beautifully on the weekly chart. I can see it now. It's above all the moving averages, kind of just bounced off of one of them, the 20-day today and this week. And so, are you long SCCO, and what are your thoughts on Southern Copper Corp?
Currently not long. I have played it in the recent past. I didn't get the entire run up from the breakout in March, but I played a little bit of between April and May. But yeah, the move in the base or the copper itself was, last month I think it was, had a really sharp move higher. Now we've pulled back, and this is a very similar chart looking at Southern Copper, one of the largest copper producers in the world. You can see the exciting move off the March low, off the March move up to $129.79. Now we pulled back a decent amount, and you can see that 106 area, you have buyers stepping in again here, so that's a positive sign. So we like to say, we talk about the markets inhaling and exhaling, so they move up a little bit, then it's like you're breathing, you have to inhale to get some more oxygen into your system. So that pullback is like an inhale. Now we can exhale. So to me, it looks like this could be another leg up on this copper miner. So it showed up on my radar this week when I was doing some market research. The What a good way to watch is, I think you had the COPX, which is the copper, the worldwide. That one made a nice new high. So that's got a basket of copper stocks in it. And then you can drill down and look for individual stocks that you can get a little more active. Yeah, so the COPX. So if we were to back that out, that $42 level is probably a 3 or 4 year high of all the copper miners and how they're moving. So that's a good broad view to look at if you're interested in the copper complex and the miners themselves. And then when I saw this pull back to its previous highs, which is this 41, 42 area, and buyers are stepping in again, this is the natural area to where you'd want to see this happen, a pullback to the breakout, the buyers step in, and then you drill down Southern Copper, that SCCO that we're looking at as one of the bigger players, so you can get a little more leverage buying the individual miner versus this ETF, if that's what you chose to do.
Yeah,
So
let's talk about that strategy here for a minute because I think this is critical for the listeners to understand our method of drilling down and essentially squeezing the lemon as much as possible. So when we find a trend, we're looking at the broadest market you possibly can look at for the validation of what we would say is a breakout. So I would start in the futures market, for example. And if I look at the copper charts and I start to study what copper has done in the last 2 to 3 months, I'm going to see a move of maybe 20%, 25%. And I'll pull up the weekly chart of copper. It is a great illustration of a breakout pattern. And if you can pull that up, if you want to pull up SCCO as well and look at the weekly charts, you will see also a great illustration of what I refer to as a major breakout. You have a 2 year period. I typically run my weekly charts in 2 year increments. And I'll reference the futures chart right now, where you had this base between 3.5 and 4. Now, earlier in 2023, it kind of hit 4.4. But if you look between 2023 and the spring of 2024, that is about as clean of a basing chart as you get. You got 3.5 to 4, 3.5 to 4, this trading range. And then what we saw in March when it broke out above 4, straight vertical from there, went from 4 to 5. So that's about a 20% move. That's 25% to be precise. Very nice. We start to see the breakout in early March. What do we do? Well, what we do is we can put some on in the futures market. That's fine. There are some ETFs that are specific to the copper futures, and you would have done 20 or 25%. There's nothing wrong with that in a few months. It's a very, very healthy return. But to Jason's point, what we would do is we would actually come down and take a look at a basket of miners, for example, in copper. And then we would look at what is the potential of this basket of miners that typically is going to outperform the underlying commodity. So in this case, it's going to be a looser chart. It's going to be a little bit more volatile. I'm looking at COPX. You could look at that 2 year chart, and it's going to be parallel in the sense that you're going to see a similar basing pattern. In here, it was from 31 to 41. So a little bit more volatile. However, when it broke out, it moved from 40 up to 52. So once again, you probably had around a 25% move. So the ETFs, the basket of miners this round has not outperformed the underlying commodity. Typically it does. You typically would see this moving, say 35%, not matching the underlying commodity. But when we drill down to the individual stock, and in this case, we're just going to use SCCO, which is included in baskets like the COPX. Well, now you're talking about some serious money because the same exact breakout that happened, and you can trace it back, it'll be the same week. All these commodities and all these stocks that are tied to commodities move in unison. We moved from 87 to 129. Well, that's a 50% move. So the point is that if you really want to squeeze a lemon and you know how to do this, the best way is look broad first, narrow down to baskets, and then get into individuals. And this happens to be a great example. There's probably a couple other examples that did not move as much as SCCO. And for those of you a little bit more conservative, you might want to just go ahead and go with the basket of miners. That way you diversify yourself. But for those who are more aggressive, what I do and what I did with silver, for example, with silver, I did this exact same strategy over the last couple months, and I chose two stocks, EXK, that's Endeavor Silver, and AG, First Majestic Silver. Now, XK did very, very well over the last couple months. It actually went up 100%. That was incredible. But the AG, not so well, only like 30, 40%. So I just split my investment in the two. But the point is, it did much, much better than the underlying SLV or the futures. And so that's what we're trying to share with you here. But yeah, when I look at SCCO, Jason, I see the dream chart, frankly. I really do. This is exactly what you want to see. And it will be very interesting. We'll continue on as we have more of a long mindset trading philosophy and investing philosophy here. We'll check back in towards the end of the summer. We're about midsummer right now. But when you look at this chart from a technical standpoint, what do you see?
Well, it's good. You have I mean, this has been in an uptrend since late 2022. You just see higher highs and higher lows, and you just see pressure to the upside. So the buyers continue to step in at higher prices than they previously did before. So on a technical, that's just buying pressure to the upside. Big institutions seeing more demand coming for copper. You know, you can dig deeper, deeper, but the idea is here is buyers have been in control steadily since late 2022, and it leveled out a little bit, and you see in August in 23 into the early 24. So sellers came in, you can see there's a little more selling pressure, so we hit 83.66, back down, then $86 again, then back down. So sellers were in control, a little bit more of an equilibrium until March came, and then sellers disappeared, buyers took control of everything. We had that nice run up, and like you said, versus copper or versus the COPX itself, you know, this was double or triple the return in the same time frame. So that's that leverage that you can get. And then we have a nice pullback here, which is what you want to see in a healthy market as people take profits, which there's nothing wrong with doing that because you never know what's going to happen tomorrow. But we look for a turn, and this is buyers stepping back in again. So this is a good area. You know, you can set, if let's say you were to play SCCO this week, or I'm sorry, SCCO this week, you could have a stop under this week's low. You know, that can be your risk, you know, down to 103 or whatever this week's low is, 103.85. And then, you know, either it goes higher or you get stopped out. I mean, I could see this consolidating, you know, maybe back up to 120, 125, then shake around a little bit. It's not going to go straight up. But over the next month or two, definitely higher prices are yet to come. So,
And when you're selecting these individual stocks, I want you to remember at the beginning of a breakout, all the stocks are going to fly because it's a whole shift of sectors for institutional money managers, speculators, traders, etc. As the trend continues, well, then the best of breed shows up. So it does make sense to start taking a look at the fundamentals as well. So if we look at SCCO and we start to see, I mean, there's been major volume, and we start to see, okay, well, this is a large organization, right? $86 billion market cap. You've got, it's profitable, 36 times earnings. It kicks off a yield of 3%, which most miners do. Well, then that's going to be institutional level quality for mutual funds to pick up. They're not going to be picking up smaller miners that are sub $1 billion market cap, that are not profitable, et cetera, et cetera. So if you're going to choose one, two, or three, I don't recommend more than three within that basket to individually invest in. I would be thinking about, if I was a mutual fund manager, what is the best breed and what is something I'm going to have proud to have on my books when I have to do my quarterly reports. Okay, so let's continue on and transition. We do have another specific stock. We're going to move over to the gold complex. And gold has, although it's had a similar breakout, it has certainly been lagging, and the gold miners have been lagging in general. And so we're going to pull up NEM, which is Newmont Corporation. And Jason, we talked about this during the inaugural episode, just the movement or lack of movement that we saw within the miners this round, especially in gold. Newmont's a phenomenal corporation, been around for a long time. It essentially is still trading under its 200-day moving average, which is shocking to me, given everything that has happened in the metals complex. So this is either the greatest buying opportunity for somebody looking to enter the place in individual stocks of miners, or there's something that we don't know that will be published. But today, to give you some context, Newmont's trading around 42. Well, you have to rewind, into 2022 after the huge pullback of the entire stock market to see the same price of 42 in October of 2022, and the market was really down. It was trading at 42. So it essentially has gone nowhere in the last couple of years, despite the breakout. However, we are seeing some great upside ever since the March breakout. It did recover. It was down as low as 29, and now it's back up to 42. But my speculation would simply be that once it gets across that 200-day moving average, which today is at 48.57, you're going to see a lot of people piling into Newmont just because, again, this is an industry titan. This is a favorite for mutual fund managers. What are you seeing in the chart, though? Because I know the fundamentals line up here. What do you see?
Yeah, it's very constructive. This weekly chart, you can see the move off 29, and then we hit that 42, the high in late 2023. You see $42.22. That was broken. That was taken out about 8 or 9 weeks ago. That large stick, one of the largest sticks on the screen, just about, or it matches some of them, the big black stick going up. And then now we've been consolidating sideways, which is very constructive. And then volumes tapered off. You can see that after the black stick in April, the large move higher, and then you can see the volume's been below average for the last 8 weeks. So that's what you want to see when a stock is consolidating. Sellers aren't in there letting it go. Buyers are trying to pick it up, but there's no heavy action. It's not volatile. It's a nice easy move between 40 and $44. So it almost looks like we call it a bull flag or a pennant, or I don't know, maybe a bullish flag. So I do have a setup here. A trigger would be a move over the most recent high, that 44.32. And then, like I said, that would probably take you up to that 200-day that Andrew's talking about, and that might bring might bring more buyers in. But if to get real technical, we're looking at that reversal here also. So we had 42.22, then we dropped to 29.02. So we've put in now at 44.32, we've taken out the most recent high of 42.22. So that's positive because you have a higher high end. You don't have a higher low end yet because that 29 is below that late 23 area. So if we do take out 44.32, then we will have higher highs and higher lows in this Newmont mining stock itself. And that's going to bring in more technical buyers, might bring in some more algorithmic trading, but it'll definitely bring in more buyers. And you see the smaller, the shorter moving averages, the 20 and the 50 is starting to curl up. The 20 is about to jump over that 50. So that's a nice positive, usually a bullish action when the smaller you want to see the smaller averages on top. Right now they're all below, so as that changes, I do think there's opportunity here. How fast it moves, I don't know. It has been lagging, but there could be some catch up. And I think on the fundamental side, a lot of the analysts are still waiting to raise their targets on this because they've just been doing so poorly. But now that gold's over 2,400, 2,300, the costs for Newmont, I think in their last earnings report, which caused that big spike in April, I think that it cost them $1,200 to pull it out of the ground, and gold's trading at $2,300. So their margins expanded quite a bit in the last year from gold running from 1800 to 2400. So I think there's a catch up play to be had.
Yes, and you're not the only one who recognizes the value. I was just looking at UBS upgraded them 2 days ago. And so, interestingly enough, it says they upgrade the shares from neutral with a $50 price target, saying it remains constructive on gold prices, which will drive consensus upward earnings revisions. So the value's there. As much as we do share the charts and the analytics from a technical standpoint, we always want to encourage listeners to take a look at the fundamentals as well, because ultimately that is what's going to speak to the broader audience, those mutual fund managers that focus more on the fundamentals. But the charts are what's actually happening. So, without further ado, we're going to wrap up today's show. And Jason, I want to give you an opportunity for any closing comments. My thought is simply this: the trend continues. The way it's been going, it's up. And if you're not on that ride, it's a good time to consider getting on that ride. I'm long silver, as I've shared. I'm long the options. I'm long a few of those stocks. That's my preferred commodity within the precious metal complex. But you can find your own. There's lots of opportunities in gold. These tickers that we mentioned today, we'll put into the show notes. There's lots of opportunities in copper. We specifically did not discuss palladium and platinum. We will leave those for future episodes. The reason being is palladium specifically is more of an industrial metal towards the tech complex. And for that reason, it's kind of seen its day. If you want to look at those charts, you're more than welcome to do so, but it is not experiencing the big bull market run that we're seeing in silver and gold. So, Jason, any closing thoughts as we wrap up today's show?
Well, I'll just echo your thought that the trend is your friend, and as you can see from these charts, that the trend is turning higher. I think we're early in that cycle. How long the cycle lasts, I do not know, but there definitely is opportunity in the commodity complex, and it could be longer than any of us are thinking about now, since it's been dormant for so long. But I'm in silver. The silver miners is usually the way I play it. My positions from a few months ago are still on, but my shorter terms I had pulled off until this week. I'm starting to build positions again in the miners. I like the SILJ junior miners. And then there's a leverage silver. I don't know if you want to throw it in there, Andrew. AGQ. If you want to play silver, it's a little leverage play on the precious metal itself. So physicals, and then I own some physical silver, and then just play the silver miners as far as trading and stuff like that.
Excellent. Well, keep your eye on the dollar as we move forward. It's been at record highs these last couple years. And if that dollar starts coming down and that Fed starts bringing these rates down, precious metals might just get the tailwind it's been looking for. Have a blessed week, and we'll catch you on the next episode.